Hello, in this video we will look at the importance of trade management. Trade management is the term for all the steps you can and must take to reduce risk and increase profits when you trade. Whether you have a passive or active approach, responsible trade management will always include placing hard stop losses at predetermined points when you first enter a trade. This helps you calculate position size so you don't risk too much of your account. Getting to break even. Using break-even stops helps to keep each and every winning trade from turning into a losing trade. New traders have a tendency to hold on to losers and close out winning trades early, so break-even stops help to offset these bad habits. As you become a more confident trader, you may wish to set trailing stops. This type of stop loss will adjust automatically if the market moves in your favour. Many traders experience negative emotions when holding longer-term positions. If you're going to keep positions open over the weekend, there must be a good reason to do this. Make the most of your technical analysis tools to help you make sensible trade management decisions. The Scaling Out strategy. A useful trade management strategy is the Scaling Out strategy. This involves selling only a portion of your position, not all of it. The fraction you sell could be a half or even 1/3, while leaving the remainder to run to your profit target or to retrace to your trailing stop level. This method allows traders to acquire early profits while keeping the rest of the position open in case a trend continues.